Hello, Trade Pros. It's Victor from Trade Pro Academy, and today we've got another amazing video for you guys. I am going to show you how you can actually catch those big market moves that everyone wants with one simple tool, just correlations. All we're going to be doing is watching correlations to find those great big market moves that people get frustrated that they miss out on. So if you guys are excited for this video, sit back, enjoy, and we're going to get into it. We're going to look at a strategy and a tool that allows you to anticipate these large market moves when we do day trade the US equity market, the US equity futures. Now we're going to show you how to identify a market leader, a market that moves other markets and travels before them, so you can grab that opportunity in a different asset, grab that big move that has already been made, but in a different asset, so we can still profit even after we've seen an extended move. So all assets have some kind of correlation that you could watch that leads the price. And today we're going to be talking about the US equities. We've got a great order flow course for you guys. It's down free in the description. Learn how to read the market, where market buyers and market sellers are coming in aggressively that dictate price movements. If you guys want to know more than that, just drop down into the description and take a look at that. Now smash that like button and that subscribe button if you haven't yet. Join Trade Pro Academy in our live morning market updates and get those bells that notify you when we do have new videos that come out, just like this one. So without further ado, let's go ahead and get started. So first, to get into this trading approach, we have to understand what correlations are first. Now, a correlation is a measure that identifies either positive or negative relationships between assets. Risk on assets move together. For example, equity futures, equity assets, they tend to move together because money flows into them when investors get greedy in hope of higher returns. So the risk off assets move together, and they move against risk on assets like equities when investors are fearful and they look for safer investments. So those safe havens are considered risk-off assets, such like bonds. So if you guys take a look here at the bottom right of the screen, we have two different correlation matrices for you. On the left-hand side, we've got the risk-on or equity correlations. From pink, we've got NASDAQ futures, yellow Dow futures, green S&P futures, and the orange-brown color is the Russell futures. On the right-hand side, we've got brown, which is bonds, yellow, which is gold, silver, which is grayish silver, and red, which is yen. So these are divided between risk on the left and risk off on the right. You can see that generally they do tend to move together, each within its respective correlation matrix. You can see Russell might be slightly a lagger, so that's something to note. We may look at that in the future of this particular video. So let's go ahead and continue. So if we have the assets that we just mentioned, we can find correlation potential in a lot of different areas. So all the US equity futures like we listed, NASDAQ, Russell 2000, Dow Jones, S&P 500, and the risk off, we got bonds, gold, yen, and silver, as we saw in the previous slide. Now, the equity correlations together do have a high positive correlation within one another, and we tend to see risk off as to have a negative correlation. So as you can see, we pulled these little blocks from MRCI. This is a correlation website, identifies a correlation matrices and the correlation between assets. So you can see equities here. YM is Dow, ES is S&P, and Q is NASDAQ. And we've got the Nikkei here as well. These are all equity correlations, and we can see they're highly positively correlated with one another. So if we look at these, 98 positive correlation, 94 positive correlation, 94. And what you'll notice is we've got the USM, so that's the bonds, the 20-year bonds there. And we've got, look at these negative correlations with these equity assets, pretty strong negative correlation with each of the equity assets. Now you'll notice that there's a 30-day and a 90-day. So correlations do tend to change from time to time. And we notice that these keep pretty consistent with one another, risk on and risk off. As you can see, the longer the correlation matrix, so like if you go 180 days perhaps, you'll see that they do stay consistent. The longer you look at them, the longer they do stay consistent. There are some discrepancies here and there, but generally we see positive within the equities and positive within the risk off, and then negative when they correlate with one another. Now, this is a great website to check out, MRCI. It shows the correlation matrix. If you have any questions about what assets are correlated with what assets, what may have negative correlation, what have no correlation whatsoever. Now we'll look at the ZB. So that's the big bonds or the USM. It depends on what the data provider may be, but they may quote them differently in different lettering. So it's same as the ZB right here. So that's what we're going to be watching for as well. It has a highly negative correlation, which is going to be very, very important for us in the coming few minutes here during this presentation. So the main thing, how do we use these correlations? What we're looking for is to find levels at which US equities are slowing and showing some discrepancies in movement between one another. So you can find correlation trades based on just the US equities. Let's say NASDAQ is ripping and then all the other equities are just slowing down. If you find those discrepancies, you may look for catch-up trades. Now, the other way to look at this is if you're going inter-correlation, so inter-market, if you're looking at risk off and risk on, if risk off is giving you an indication that they're going to reverse and start falling, actually, what we do expect is to see risk on actually accelerate and push to the upside. So those are the two main ways we're going to look at this and find the opportunity in these correlations. We're going to show you examples of both, but that's what we're going to be looking for. And this is how we identify the potential anticipated moves and the larger moves that you may capture. So here it is, everyone. We got the intra-equity correlation opportunity. This is what I was talking about. We have two different ways of identifying these. So we split it here down the middle for you. One, they're both on CR charts, but here on the left-hand side, we've got the correlation matrix that we showed you just based on pure lines. These are a line chart, and what they do is just show you the general momentum rather than levels. So if you see right here, Russell just dropping while all other equities are pushing to the upside, what we can identify is a potential long opportunity in NASDAQ, a potential long opportunity in the Russell to catch up to the rest of these equity correlations. Now, this doesn't have to happen, but if you combine this with your market structure and your order flow and everything else, you can find a really good opportunity in Russell to catch up to a lot of these increasing equities on this decreasing downside Russell. So typically what we do expect is to see NASDAQ as a leader in these correlations. So wherever NASDAQ goes, we do seem to see the other equities follow. NASDAQ is full of strong tech stocks that do tend to lead the market, big names, big movers, the FANG, Microsoft. So that's why we look at NASDAQ as a leader and Russell more of a laggard because it has small cap equities in it. Now, the small cap equities might be a little more sensitive to things, but they do tend to lag just slightly. So just watch out for that. The key correlation trade, an amazing correlation trade, is identifying the NASDAQ with the S&P. So if you can identify NASDAQ movements to the upside or downside aggressively and the S&P hasn't gotten there yet, that'd be a great opportunity because the S&P has a lot of NASDAQ names on it and tends to move with NASDAQ pretty well. Now, on the right-hand side here, what we've done is created this correlation matrix in more of a chart format. So what we've done is actually divided up NASDAQ at the top, S&P, then Dow, and at the bottom, Russell on a 10-tick futures bar chart, so a range chart right here. Now, what we could do here is identify the support and resistance levels very, very easily with our eyes, or if you want to draw them, and identify where those exponential moves are. So for example, NASDAQ at the top, because we want to see if this guy leads. So if NASDAQ starts breaking through resistance and all the other equities aren't at those resistance levels yet, then we could identify a potential move to catch up with the NASDAQ. If we've already missed that long NASDAQ trade, there's plenty of opportunity. You see Russell is hanging out here down below. Russell is just the lagging market right here. What NASDAQ is telling us is it has not ripped through this resistance point. So it's kind of in no man's land while the S&P and the Dow are kind of strong. So what we want to see in this scenario is let's wait for that NASDAQ to either rip up through resistance or down through support and look for catch-up trades in some of these other equity markets. So if we look at a potential example from today, April 20th, we could maybe identify a decent trade opportunity. So right here is the chart that we laid out for you before we started this presentation. It's amazing because what we can see is this great correlation trade setup in the NASDAQ. You can see this blue line is a key support structure that I had mapped out, and we mapped it out on all the charts based on what the NASDAQ was giving us. We can see this vertical green line right here that identifies where NASDAQ actually does start to push down to the downside and look for that break. Now, what you can see at that same vertical line, we get the opportunity to start shorting the S&P 500 because it has not yet broken through that support structure. Dow has, and we get the opportunity for Russell as well. Now, what we've done is identify another green vertical line at these same levels because this is the key resistance that was previously support. If we can identify that the NASDAQ pops above that level, when it does, then we can look for potential longs in the other markets to catch up. So the pop through that level could help us identify, hey, maybe we can get a long on Russell to see if we can ride out the more extended move, or the S&P right here. So this is a great tool that we like to identify the correlation trades to play catch up with the strong leader in the equity market. Now, it's the same for risk off correlation. So what we do with the risk off correlation, we generate a risk on risk off correlation opportunity. So that means by following the risk off assets, mainly the ZB, I like to follow the ZB because it holds true to its correlation. Gold sometimes changes, so does silver, but the bond market usually stays very consistent in a strong negative correlation with the equity market and the S&P mainly. So we do in this correlation scenario, now that we've identified that they're inversely correlated, is waiting for opportunity in the bond market. So if the bond market starts dropping or increasing at a certain point, we can identify a potential reversal in the trend on the S&P. So again, to the left here, we have our correlation matrices, and this is where we start off. If we start to see these brown bond lines running up, maybe we could anticipate a divergence and a drop back lower in the equity market. So that's what I like to see at first before I go into my trusty right-hand chart here, where I can identify the support resistance levels based on the range bars. So right here, this is the key opportunity right here. If we identify this with a vertical line, you can see right here, it's pretty simple. Risk off drops off aggressively way before the equity market rallies. So if we can identify this drop off before it even happens right here in the bond market, if we can identify this drop off before the equity market rallies, we've identified a very, very strong potential up move in the S&P for a very extended move. You can see right here, if we go from the 30s all the way up to the 70s, that's a 40-point move on this amazing correlation play based on the bond market just tanking. So I love using these inter-market correlations just as much as the intra-market. If anything, if you can spot these crazy bond moves up or down, you have a very good opportunity to catch this lagging S&P to the inverse of what the bonds are doing. So I really, really love that trade. Now, again, these are just a few examples for you guys. I really recommend testing it out on your own and identifying some correlations that work. I gave you a list of correlations that are very good to use, especially at the beginning. They're just no-brainers. So if you guys want to practice, we're using Sierra charts here on the platform, and I really hope you guys enjoyed this strategy correlation video. You have the potential of catching these crazy moves if you can identify when the markets break and when the correlations lead some of these markets. So this is Victoria from TRADEPRO Academy. I really hope you guys enjoyed this video. Smash that like button, hit that subscribe button, and drop a comment down below. What do you guys want to see next? How did you guys enjoy this video? And we'll see you next time.